We've got about $1.2 trillion of wealth to be transferred to the next generation over the next 20 odd years. So you are seeing a lot of focus on institutionalizing family businesses that are in the midst of handing over to the next generation. And it's not just about growing the business itself and what areas it can grow into, but it's also looking at what are the passions that we have. What are the areas of innovation that 10 years ago would never have been associated with our business, but it's something which the next generation has a great deal of interest in.
Joining me on the couch is the CIO of UBS Middle East. His name is Fahd Iqbal. How do you see the rise of alternative assets? And how do you think that's going to contribute towards any country's capital market?
Statistically, the inclusion of even a small amount of alternative assets into a diversified portfolio simultaneously increases the return of your portfolio and decreases the volatility of it. So it is a real win-win proposition.
Hello, everybody. Welcome to this episode of Couchonomics with Arjun. Joining me on the couch is the CIO, which is the Chief Investment Officer of UBS Middle East. His name is Fahd Iqbal. I met Fahad very recently at an event in Riyadh, and we got talking about the future of investments in the region. So I thought, this is a great opportunity to get him on the couch and sort of share his wisdom with the wider world. So with that, I welcome Fahad on the couch. Fahad,
well, thank you very much. Thank you. It's such a pleasure to be here. Thank you.
And thank you for accepting the invitation.
Oh, not at all.
I know it was a quick fire discussion, and then next thing we knew, we were slotting you in. So I think we have a wide spectrum of listeners. I think they could benefit with a brief introduction of what does a CIO do.
Sure, absolutely. So the Chief Investment Office itself is responsible for putting together what we call the house view, which is our recommendation on which asset classes investors should be overweight or underweight in across their portfolios. And my function as CIO Middle East within UBS is a little bit dual-fold. Each of our CIOs has a specialty in a particular segment, asset class, region, so on and so forth. So mine, of course, is parts of the Middle East, primarily equities and real estate. And part of my function is to really help set the view on the Middle East itself. And given the ongoing merger between Credit Suisse and UBS, this part is obviously still a little bit of a transition work in progress. And then the other part of my role is really to be the communications channel for the house view to our clients, to our stakeholders, our employees across the Middle East business unit itself. So we do have offices in locations across the Middle East. So Saudi, we've got Dubai, and we've got Doha, Riyadh, Dubai and Doha, I should say. And then, of course, we've got our offices out of Geneva and Zurich as well. So all of those covering the Middle East.
Okay. You've been in the region for a while?
I've been here since 2006.
All right.
So it's been a stretch, yeah.
Right. In a few words, how has the world of sort of investment and wealth management sort of evolved in the last, 18 years?
For the Middle East, there's been tremendous change. I mean, I remember when I first moved here, I started off on the sell side, which basically means I was an analyst for an investment bank, and my clients were institutional fund managers. And at that time, it was really a new and emerging function. There was a number of companies who didn't understand this concept of why an analyst is looking at stocks and giving price targets. And you fast forward to today, and you've got a really healthy ecosystem, a very robust, broad, liquid financial market with good depth, and much greater institutionalization. I think one of the things that's really become quite interesting, especially in this post-COVID environment, this post-2020 environment, where we've seen the launch of golden visas in the UAE, where you've seen a large number of companies relocating offices, setting up regional headquarters, is to see the sheer spectrum of financial services offerings that you have in the Middle East. Because it used to be that the offices that were set up here back in the day you were essentially, and I'm simplifying it, but you were essentially a sales office, a rep office, whose job was to sell Middle East assets to a Middle East market. But now it's become a proper wholesale global hub where you could be engaging in any manner of activities regarding a global set of assets. And yes, your clientele are still very Middle East focused, but the Middle East clients are no longer GCC citizens or people from the global south who have relocated here. You have people from every walk of life from all over the world that are relocating here. So it's grown tremendously in the time that I've been here.
No, that's very interesting. And obviously, I by no means do I have the same level of exposure as you have, but in sort of the roles I've held, and I've been around here since 2009, a little lesser than you, I've actually seen the shift, right?
Yes.
And I'm going to come back later and ask you a few questions around, how's the investor type evolved, and where's the interest coming from, and what type of asset classes are actually gaining more traction. But I'll start with the favorite line or the most popular line I see in every investment report, which is published by, I guess, every investment bank or wealth management firm these days, is the great wealth transfer, right? And tens of trillions of dollars apparently over the next couple of decades will move from baby boomers to, I guess, millennials and whatever gen is around into. I don't know if it's Z or double alpha or alpha or whatever.
Exactly,
whatever it is. So a few questions for you, right? Specifically. Are we seeing or are we expecting this same transfer to take place in the Middle East? Are we going to be party to it, right? What are some of the key implications of that to the sector that you belong to, whether they are international players like yourselves or local capital market players who are also sort of either competing or partnering with you guys, and what sort of responses are you starting to see? Like how is the sector preparing themselves for, I guess, capturing the opportunity with this wealth transfer from a local or a regional perspective?
Sure, no, that's a great question, and it is an important topic, because by our estimates, we've got about $1.2 trillion of wealth to be transferred to the next generation over the next 20 odd years. That's quite a significant amount. And for the Middle East specifically, I don't really have a number for what its share is, but we can kind of ballpark it in our minds, given how much of a share the Middle East has. And you are seeing some important shifts occur in the Middle East in preparation for this, in anticipation of this. A large part of that is really the institutionalization of processes. So you are seeing a lot of focus on institutionalizing family businesses that are in the midst of handing over to the next generation and making sure that there is an orderly transition from one generation to the next. And certainly that's happening at the operational level for the business itself, but it's also occurring for the underlying family wealth as well. And so as a result, and I'm sure you've seen it too, there's been a proliferation of family offices being set up. Because, going back, to when you and I first moved here, it was quite unusual to find a family office. Quite often, high net worth individuals would, I wouldn't say it was the majority of the time, but certainly it was common, that there would be an enormous amount of wealth simply kept in a current account and, being dealt with the branch manager. And it's shifted significantly to a setup where there is this recognition that you do need to have a professional management in place to take charge of that wealth, to manage it, to invest it, to ensure that it's kept safe on a generation-to-generation level, and it grows alongside with it. And then as those family offices have set up, the second step that we're seeing over the course of development has been to really reinforce the corporate governance of these family offices, ensure that they are running like a proper, global standard organization, which means You want to have an investment committee, you want to have compliance officers, you want to have the whole shebang. You're seeing it at the family level as well. You're seeing increasingly families that are setting up a family charter, a detailed one. That will be a mini book in many instances, where they are defining what their ethos is, what their targets are, what their ambitions are. And it's not just about growing the business itself and what areas it can grow into, but it's also looking at what are the passions that we have, what are the areas of philanthropy that we can focus on, what are the areas of innovation that 10 years ago would never have been associated with our business, but it's something which the next generation has a great deal of interest in. How can we start to tap into that potential as well? So these are the kind of changes that we're seeing.
So let me ask you a question. And please choose not to respond here. So I've seen growth in family offices. I actually worked for a very large conglomerate, a family-owned conglomerate, and my offices were right next to the family offices network offices, and I kind of used to get into discussions, so learned a little bit about it. How much of the reaction, or how much of the response or reaction for having these family offices has been, if I may put it, the shortcomings of the banks and the wealth managers not doing what they should have been doing in the first place, versus it's global best practices, so let's do that?
I think it's come from a place of realizing, you've had a couple of very large and sizable financial market crashes over the last 18 years, very painful ones. And for a lot of wealthy families, high net worth individuals, you did find that early on during the period that I'd moved here, so again, 15 to 18 years ago, a lot of wealth was concentrated in local assets, in local listings. And the realization came essentially through experience that we actually need to have a diversified portfolio. I understand now the need for having a multi-asset portfolio. I understand the need for having a spectrum of investments ranging from very liquid to very illiquid to help me navigate these ups and downs. So I think it's a process. I mean, we've seen Dubai itself, evolve through the exact same thing. Every time there's been a crash, the government has kind of looked at what went wrong. Okay, what areas do we need to address and reinforce? And that has allowed Dubai to come out of each of those crashes actually stronger and better positioned for the next upturn. And, you've seen a parallel kind of shift in mindset for the various families here as well. Okay. At least that's been my take.
No, and that fair enough. The point was to have your take. So one of your reports I was reading, which is around billionaires, and it was an interesting sort of, I think, graph in it or chart in it, which talked about the movements of billionaires, and I think the outcome was the MENA region, specifically the GCC, have been sort of, I guess, net gainers of billionaires, right? Inflows, right? And UAE has been arguably the most popular destination among that. Now, I think a lot of that could be based on some of the geopolitical tensions that exist, right? But some of the movements is not just based on geopolitical reasons, that is, right? So question for you, outside the geopolitical issues where people are just finding a safe haven for their money because they don't want exposed to some sort of war, what are the 2 or 3 key drivers that's driving people to this part of the world, right, with their wealth, especially billionaires, right? And has that really impacted the way you guys are set up? And I say you guys not in terms of UBS, but the entire sector has set itself up for this inflow of billionaires.
So I would say that, well, actually, before I answer that, I would clarify that there has been an influx of billionaires and of course millionaires.
Yes, millionaires.
In terms of millionaires, the UAE has definitely been the biggest beneficiary globally. I think 3 consecutive years now. For billionaires, it has been one of the biggest, not the outright biggest, but certainly. But relative to the size of the country, it's certainly an outsized beneficiary. You're absolutely right that geopolitics has played a certain part, a certain role. I think to quite an extent, a lot of the decision making has been driven by the personal experiences that the billionaires and millionaires have had, because you do have an environment here where there is immense safety and security. So from our family office report, from our billionaires report, we have seen that that has been one of the key reasons. It's not been one single thing, but that's certainly been one of the reasons. The other nice to haves reason has been the lovely weather, which is more or less, it's not all year round, but my argument has always been, yes, I know the summers here are pretty intense, but then winters in other countries are also intense. So which would you rather have? And of course, let's not forget the income tax-free environment that we're in has been certainly a big factor in attracting talent and millionaires and billionaires. But all of that, these are all important functions, but it really, I don't think it would have occurred had it not been for the fact that the infrastructure in the UAE exists to allow the people moving in here to conduct the work that they've been doing.
So they can get catered to. That's interesting.
Yes, exactly. They can continue to do the work they have been doing. Because look, there are other places in the world where you get nice weather, where you get safety, where you get either low tax or a tax-free environment. But UAE specifically has benefited significantly. And it is because you can continue to do the work that you have been doing. You can do it here a lot more easily, or just as easily. And in a world where, post 2020, we realize that remote working or working in different time zones is actually very, very possible. You don't
Not
have
if
to be
you work
physically.
for JP Morgan.
Oh, yeah?
Because they're moving to a 5-day week. No, go ahead, please.
But if I personally think that if that capability was not there, you wouldn't have seen as many people moving in.
No, I agree. I think life is becoming borderless, and I think what's impressive to hear is you saying that the infrastructure existed here in all senses. And and what I mean by infrastructure is infrastructure for them to be actually serviced from a wealth management and investment management perspective.
Absolutely.
I don't mean infrastructure in terms of houses and cars and planes. And
Sure.
those existed.
Sure.
And there are many countries which they do. Let me ask another angle, and apologies, I keep putting you on spot with these interesting trends,
not
but
at
they're
all.
all your reports, so it's it's your fault. So very interesting dynamic, right? So younger people are getting wealthier. Right, tech has been one of the big drivers in it. Right, so tech-based billionaires are increasing.
Absolutely.
People are getting increasingly digitally savvy, and that's not just the youngsters; even the older generation is. Right, by and large, people want greater diversification. If not diversification, they definitely want greater choice in terms of product, especially if they want to position their money. Right, and there is an element that they want the process to be efficient, and an element of value for money in terms of value for advice, right? These are very interesting trends which are all sort of coming together, right? They're congregating together. And they're very different to what classical red carpet, wealth management, private banking was to offer, right? Because in a way, it never digitally savvy. It was all about receiving people. Typically, they were old men. I'm overgeneralizing. How's that manifesting itself from a product perspective, right?
Sure.
If I don't necessarily want to ask from an advice perspective, because yes, we can talk about robo-advisory and so on and so forth, but how's that actually impacting the way you guys look at building portfolios, the way you're seeing asset classes go in and out of popularity?
So going digital, from my perspective, is very much a productivity tool. Right? It's not a replacement of the human interface itself.
Okay.
And so we are seeing a lot of banks introduce very powerful digital interfaces, at UBS. But, in my mind, it's going to be very difficult to replace, you mentioned robo-advisors. I think it'll be very difficult to replace the human interface because when markets are going up and when things are going great, everyone's very happy. You don't really feel the need necessarily to talk to a person, but you overwhelmingly do when there's a problem. I really only pick up the phone to call somebody if there's a service that I'm using, if there's a problem. I'm not going to speak to somebody if I need something done. I can get it done on my phone. And if I have to speak to a robo-advisor, or I have to go through the whole channel of press 1 for this, press 2 for this, it is a frustrating process. Nobody wants that. So it's a bear market problem, right?
Yeah, and just to confirm with that, I actually spoke to one of the largest robo-advisors in the US, and they went hybrid very, very quickly.
You have to.
Yeah.
I think you have to.
Yeah.
Because
so that just confirms your point.
Yeah, exactly. It's a productivity tool, as I said, not a replacement. In terms of what it does for the wealth management process, it hasn't changed the process. It hasn't changed the way we look at different asset classes. It's certainly changed the offerings within individual asset classes, because of course now you want to be investing in the digitalization process, and you want to be benefiting from it financially, and access to that kind of technology is changing. Because if you look at the US, which is really the center of where all new technology is coming out from, if you only rely on NASDAQ or the listed equity space, you are going to find that you are quite constrained in terms of the total amount of investment set opportunity that you have access to. Increasingly, a lot of really interesting, really high growth opportunities that are coming your way are staying private for longer and longer. And so for investors who want to make sure that they have exposure to that full spectrum, it is important to be in various different asset classes. But that process of deciding how much to allocate to each asset class and how your balanced portfolio should look, that in of itself hasn't significantly changed.
So can I just press on you a little bit on this, right? So one of the key trends we've seen is robo was very attractive because a lot of people said, it will further democratize access to wealth management,
Yes.
right? It'll bring in the mass affluent. So it's not just about the ultra high net worths and the high net worths, right? Because there is a cost economics angle that we can, that productivity gives the cost economics to be able to service people like me, right? Not mass affluent who wants to get in, wants a portfolio. Overlay AI on it, right? Where you can now start to build portfolios using, artificial intelligence, which is a lot more acute, and you don't have to be classically classified into 5 generic categories, because I think we're all a little bit more unique than 5 generic capabilities that happen. But isn't that putting a lot of stress on the product side? Because you're having to, I guess, build that many more portfolios which are tailored to that many more profiles? Or am I just overcomplicating it because I like doing things like that?
No, I don't think it puts stress on the product that way. I think there are changes that are happening in the product space, absolutely, and I think they're really interesting ones. Certainly, it is democratizing. Oh gosh, completely mispronouncing this.
Yeah, democratization.
Democratization. It is definitely leading to a democratization of the investment process.
Yep.
And the mass affluent now have a lot more access to these investment products that were previously not available. And I think that's a fantastic thing. I mean, I've been trying to teach my kids to invest early and trying to teach them that the stock market should ultimately view, or financial markets rather, should be viewed, not as an arena to generate enormous amounts of wealth or as some kind of, risky venture for you to throw money at. You should view it as a savings tool, and everybody should have access to it as a result. So I think it's a fantastic development. I do think what is changing is the fact that the proliferation of products such as, well, for example, ETFs. I think that's a really simple example. Look at what that's doing in terms of the investment decision. Increasingly, a lot of clients will come and say that, well, I do want to have exposure to, for example, let's say US equities. Why should I pay the fees associated with a fund for that runs a basic US equities portfolio when I can just buy the ETF on the cheap? And I would agree with that. That's completely fine. Increasingly, investors aren't really willing to pay the fees that are associated with mutual funds unless you, either have a really fantastic long-term track record and there's been, a strong consistency in that long-term performance, or B, there's something very specific that they're offering which is not necessarily available in a vanilla ETF product. Otherwise, they're very happy to save that little bit of money and just invest directly in a simple, cheap product like an ETF, which will deliver you good returns over the long term.
I'm a firm believer in it.
Absolutely.
Yeah.
So that is something that is changing. But again, it comes back to that same point that yes, having that AI overlay, helping you in the investment decision is fantastic. What needs to be made sure of is how do these products and services work through the cycle itself. A lot of these things will work great on the way up. On the way down, not necessarily through the virtues of the product itself, but just our own human behavior where panic can sometimes cause us to prematurely exit investments and then miss out on the subsequent recovery. There needs to be a process in place to ensure that people don't respond too hastily.
Okay, we're going to switch topics. There was another very interesting thing I picked up in your report. So at an aggregate level, the wealth growth among billionaires slowed down since 2020.
That's correct, yes. I mean, if you look at the year-on-year, every year change, there was, let's see if I can remember the numbers correctly. So the Billionaires report that we published, it's in its 10th year now. It is the longest running, most comprehensive study of its kind. And from 2015 through to 2020, you saw roughly 10% per annum growth in billionaires' wealth. But 2020 onwards, it's been basically flat. But that does disguise essentially two major developments. So it does disguise some important developments. Number one, if you look at it in aggregate, 2021 was a fantastic year, and you saw a good 30% jump in billionaire wealth. But then 2022 was a pretty terrible year, and you saw approximately 20% decline. And then there's been a steady recovery since to bring us back to the levels we were at 2020. So it does disguise some significant volatility there. But the second thing it disguises is really the fact that the vast bulk of that seemingly flat development in billionaires' wealth has been driven by Chinese billionaire wealth essentially being, I was about to say stagnant, actually it shrunk a little bit since 2020. And that's been on the back of, it shrunk by a good 15% actually. And that's been on the back of regulatory changes, weakness in the Chinese equity market, the Common Prosperity Program. If you look at what's happening in North America, it's been actually billionaire wealth accelerated in the second half of the past decade. So 2015 to 2020, you saw about a 40% increase in billionaire wealth in North America. But the next 5 years, it was close to a 50% increase.
Wow.
And a lot of that is of course, coming from tech and industrials and so on. In Europe, there's been fairly robust growth. It's moderated, but remained robust. APAC has been a mixed bag. India's been a standout performer in APAC. It is now, in terms of overall wealth, the third highest globally country for wealth, coming in after US and China. So it's had an astounding level of success.
It has. Although it does have to get rid of its income disparity, which I personally feel sometimes it gets wider and wider, which is not a great phenomena. Let's switch to real estate for a second,
sure.
Right? And let's come back to the region. So geopolitical tension exists in the wider MENA region, but the UAE still stays a very strong safe haven, right? Some are arguing that maybe Dubai is starting to sort of, I guess, slow down, if I may use that term. Abu Dhabi has shown a lot of resilience, right? The question to me is more specific, is do you actually continue to see this trend of the UAE being a safe haven from a real estate investment perspective stay on for the foreseeable future?
Oh yes, absolutely.
Right.
Absolutely. I mean, it's been a safe haven for a while.
Yep.
And its role as a safe haven has broadened from being a Middle East safe haven, pre-2020 to being a global safe haven post-2020. And I see greater resilience now in the UAE than what existed before. I mean, if I, again, go back to when I first moved to UAE back in 2006, and I would tell people, I was living in England at the time, and I remember telling people that I'm moving to Dubai. Some of the feedback that I got was, why are you moving to the Middle East? It's a dangerous area. All it takes is for one, horrible incident to occur, and that whole economy is going to collapse. And it's a fair concern. It was very common back then as well. And I think it's fair to say that, God forbid, if anything were to occur like that back then, yes, it would have had a significantly negative impact on the economy. But you fast forward to where we are today, and we have seen in the last few years when geopolitical risk did pick up, we have seen direct attacks in Saudi Arabia, in the UAE. Granted, they were limited, and luckily the fallout was very, very limited as well. So thank God for that. But for me, it really reinforced the fact that this region has become so much more resilient because not only, if you look purely at what happened with the equity market, if you look at what happened with the overall economic activity, if you look at what happened with people's sentiment, there really wasn't any impact in the midst of those events on either of those measures. And I really think it reflects very well just how much more resilient this region has become, but also how much better understood it has become as well. Because back in the day, there was no differentiation between, say, Dubai versus, I don't know, a country like Syria or a country like Iraq. It was, in a lot of people's minds, this is just one big...
It's one big Middle East.
One big block.
Yeah, agreed. But let me ask you a question because I can't help myself on this. I completely buy the resilience argument. I've been here as 16 years. I've actually seen the economy change. Actually, the attitude of the people living here has changed, right? The resilience of the economy in a lot of ways is the function of the investors and the people in the market, right?
Absolutely.
People like you, me, and lots of others, and people with a lot more money than I guess both of us put together, and who are willing to put their big bucks into the market. I've seen that. But here's a hypothesis. Are we just... has Middle East turned out to be the net, I guess, winner on the back of all the strife and challenges we are seeing in Europe?
I would say so, definitely. And you're seeing it today as well.
Yeah.
I mean, the number of people that are seeking to relocate on an ongoing basis from well-developed Western regions across Europe, North America, developed Asia, it's still very, very strong. And I think a lot of it is coming from the fact that these are countries that are facing significant difficulties, be it economic difficulty, be it some kind of political difficulty, be it a security difficulty. And they see that, Dubai offers you, the UAE overall, I should say, offers you a very compelling mix of robust economic activity and security. And really what more is someone going to be looking for when they're thinking about where do I want to live, where do I want to work? These are the two basic things you're looking for.
So if I take that same argument for a second, and please humor me, again, choose not to respond if you don't want to. Saudi Arabia is now coming to the party from a real estate perspective,
yes.
Right? There's all kinds of new laws being passed as far as real estate regulation is concerned. Foreigners will be allowed to sort of invest, obviously, in controlled environments, but that'll open up, right? Does that pose a competing threat to the UAE enjoying this sort of net plus scenario of whether it's African money flowing in, whether it's European money, whether it's even Asian money flowing in here? Do you see Saudi Arabia now in the next 3 to 5 years become as formidable a real estate play, not just for Saudi repatriation of Saudi money, but also foreign money?
As formidable as UAE, no, it's going to take longer because UAE is where it is today after 21 years of development. And certainly, I don't think it'll take Saudi that long.
Yep.
But I think 5 years is too short a
Too
time
short
for it
time,
to.
okay.
But yes, it will become certainly a formidable competitor in terms of attracting investment in real estate as well. But I don't see this as a negative for UAE at all. And I was asked the same question back in 2015 when the Vision 2030 program was launched. And for me, I couldn't be more happy to see these things happen, because for me, Saudi Arabia coming into its own and realizing its full potential is nothing but positive, not just for UAE, but for the region as a whole, because it is going to draw in more capital. And it's going to draw in more capital to the UAE as well. Sure, the UAE's slice in the overall pie of the Middle East may well shrink,
But the overall
but that
pie
pie
grows.
is going to grow dramatically as a result. And so I've always said, capital is going to attract capital. It's not as if, people don't ask, Singapore is investing more in its ports. Isn't that a significant threat to Hong Kong? No one says that, because we understand that actually all of these things have a net positive impact overall, because ultimately that competitive environment forces other countries to similarly pick up their game as well. I don't think we would have seen, as an example, golden visas being launched in the UAE as quickly as they were had the Vision 2030 program not been launched.
Agreed with you. Yeah.
And look how positive it's been for the UAE
Yeah,
overall.
and there's more reformation, there's more reform down the line.
Absolutely.
There's this, my argument here is there is this entire silver economy opportunity, right? And people are living longer, people are living healthier.
Absolutely.
People are holding on to that, and they're the wealthy ones.
Yes.
Let's be honest,
Yeah.
right? I wouldn't be surprised if the UAE doesn't choose to do a lot more, right, for that segment. Yes,
I agree
healthcare
completely.
needs to come around a little bit more, care needs to come around a little bit more, but it's a small dynamic country in a lot of ways, which allows them to actually do it. I do agree that it would be. I think what will be very interesting in my view is in about 10 years time, and it'll depend on how much of Vision 2030 comes to reality, because the one difference between 2015 when Vision 2030 came, which was just a piece of paper, and now we actually see the difference, right? I've been going to Riyadh for 12 years.
Yes.
The city doesn't feel the same.
It is not the same.
Yeah, it doesn't feel the same. It's become, in my humble opinion, become highly livable from every context, right? From every walk of life, from any nationality you come from, and it's a large country.
It is. I don't think any country has seen the sheer scale of economic and social and cultural change
Simultaneously.
that Saudi has in that extremely tight
period.
period. I mean, yes, China's gone through enormous changes, but look at the time period that it took. What Saudi has done in such a short period of time is frankly, it's borderline miraculous. It's been an incredible achievement.
Yeah, and I personally think the best is yet to come, because I spend 3 days a week there every week, and the more I see, the more I get sort of, if I may say, under the skin of the city. Actually, I'm actually incredibly impressed. I'll shift topics. I'm cognizant of time. I've got a few other questions that I do want to talk about.
Sure.
One of your reports talks about de-globalization, right? So, simple question for you. Is this really happening, or is this just a lot of talk with a few data points to support it, right? And if it is happening, does MENA gain, the MENA region gain? What does the MENA region need to do differently to kind of become net gainers out of this de-globalization shift?
Sure, no, that's a great question. De-globalization is very real. And it is a core part of our sort of our 10-year strategic view as one of the 5 factors that will help drive elevated growth and inflation over the coming decade. And you can see it. You can see it economically. You can see it politically. Politically, we used to be in a globalized world where there was one single superpower and there was an allied view. And that has changed now, shifted into a more of a multipolar world. And instead of strong bilateral relations, you have increasingly multilateral relations. It has resulted in a lot of economic developments as well. I mean, global trade as a percentage of GDP is no longer rising rapidly the way it was. Supply chains have shifted. Instead of having a single global supply chain, you've got lots of regional ones. Instead of having one global trade agreement, you've got multiple regional ones in play. And you're seeing that being reflected in, to your point about how the MENA region benefits from this. I think the MENA region has actually played the process of deglobalization incredibly well. Because if you look at countries like Turkey, UAE, Saudi Arabia, Qatar, I would add Qatar in there as well, but Qatar has actually been doing this thing, I think, for quite a bit longer. They have really managed this multilateralism beautifully in maintaining strong relations with the US, maintaining relations with Europe, maintaining relations with Russia and with China and with India. So all the different sources of power and economic growth and sheer size. And it has been a beneficiary of all of them. And a simple example is the comprehensive economic programs that the UAE has been signing incredibly rapidly with so many different countries. So these are all signs and outcomes of the process of deglobalization. And the MENA region, specific countries within the MENA region, have been beneficiaries of it because of the way that they have managed it diplomatically and economically and politically.
Yeah. And I agree with that. I think they've definitely managed it diplomatically incredibly well. And I think that plays to that whole safety and resilience angle too. I think it all sort of connects together. Shifting topic again. Private wealth, right, is a big topic these days, right? Alternative investment categories is another sort of big topic. I'm going to try and merge all these topics into one because I don't want to. So we're seeing a growth in alternative investment, if I may say, types of alternative investments, right? And whether that's private equity, whether it's real estate, whether it's other forms of alternative assets. The genie's out of the bag as far as this one is concerned, right? It continues to grow, right? How do you see the big shift in the way the wealth portfolios will be constructed going forward with, I guess, a lot of these private, a lot of these alternative assets coming in, and then there is this trend around tokenizing some of this wealth, which makes it that much more accessible to a larger segment of man. And we're not going to get into tokenization of real world assets. We've had a number of conversations on this table.
Well, I'm no expert on that anyway, so it's for the best.
But I was not going to ask you about the tokenization, but as a CIO, you're obviously seeing this as an asset class now that is becoming more easily to actually put in the bouquet of your thinking. So how do you see that evolving, right? How do you see the rise of alternative assets rising, and how do you think that's going to contribute towards, I guess, any country's capital market, the stability and the strength of the capital markets?
Absolutely. No, it's a really great topic. It's a really important topic. Alternative assets, which it encompasses private markets, so private equity, private credit. It encompasses real estate. It encompasses commodities. We have found that historically and statistically, the inclusion of even a small amount of alternative assets into a diversified portfolio simultaneously increases the return of your portfolio and decreases the volatility of it. So it is a real win-win proposition. And one of the changes that we've been seeing is the more widespread adoption of the so-called endowment model, where you have about 40% of your portfolio in alternatives and 40% in listed equities and maybe 20% in fixed income. And the reason why that was not always accessible for investors in the past was because alternatives will very often tie up liquidity for extended periods of time. So it wasn't always viable for many investors. I think investors' understanding hadn't reached the level where they understood the actual impact that the inclusion of these portfolios has, and also the availability of, as you were saying, the availability of and the access to alternative investments has improved significantly as well, and will continue to do so, reaching a point where mass affluent will also have easy access to it. So from our perspective, it's a fantastic development. We do see it as one of the most important areas for investors to focus on in 2025. And also, there is a role that alternative investments and subsequently that private wealth can play when it comes to these long-term targets we have for overall, global decarbonization, for sustainable investing, for impact investing. Because very often the route to those investments will be coming from private markets. And in order to fund them, they will need significant amounts of capital to come in. And one of the richest sources of capital is ultimately private wealth. And for a lot of, you were asking about billionaires earlier, a lot of the attention that you're seeing increasingly from billionaires, from family offices, is increasingly towards sustainable investments. Part of that is also coming from the fact that the next generation is stepping in, who have much more progressive views on social engagement. But it's a really powerful area from an investment standpoint. And it's something that will continue to be an important area.
And one can feel it, and one can actually see it in the capital market. Last two questions. I met somebody, and I'm going to quote what the person said. Failures of central banks to see a sustained jump in inflation has sort of negatively affected their credibility among the investor category, right? First question, is that true, right? And, is there an end to this so-called shortcomings, or is now that factored into the thinking?
So I think it's unfair to point the finger purely, solely at central banks. The street as a whole didn't see that sustained increase in inflation coming. And I will say, in fairness, we were coming out of a period where we were emerging from lockdown. Spending on goods collapsed quite significantly. Spending on services increased dramatically. For the first time ever, we had a significant divergence in spending between the two. We had supply chain issues coming from Russia's invasion of Ukraine. So to get it wrong on the back of those developments, I think is pretty fair. It was a very difficult and complicated thing to understand fully and appreciate. That said, yes, I do think that is true, that the credibility of central banks has been negatively affected by a large number of investors and by the market as a whole. And you do see it in the sense that if you look at market forecasts of where something as simple as central bank rates are going to be, it has been unusually volatile. It's been and forecasts of it have been unusually fluid. So that does point to the sheer amount of uncertainty that's there. But one of the questions I get quite repeatedly is an extrapolation of this trend. That, okay, the credibility is down, it's going to continue declining, and therefore central banks will become less relevant or less important in terms of financial market analysis going forward. And that I completely disagree with. I do think central bank credibility has been improving again. It has been coming back. Point number one. But point number two, much more importantly, I think central banks play a much more important role today than they have done in the past. And that's because in the past, pre-financial crisis, central banks essentially had one important tool at their disposal, and that was interest rates, which is, of course, how it's always worked. But today, central banks have two tools. They have interest rates and they have quantitative easing. And that is an enormously powerful tool. At a personal level, am I a fan of QE? No, I'm not, because I think it does have a distortionary impact on markets. I do think it goes against the grain of the ethos of capitalism, but the reality is it is there. and it's not going away. To paraphrase what
And
you were
what
saying.
version of capitalism are you talking about? We're not going to get into that. Sorry.
No, but to paraphrase what you were, and to borrow your earlier words, the genie is out of the bottle. You're not getting that back in again. QE is here to stay, and I think it's going to be a tool that is used again. And certainly, if we're in an environment where you start to see a disorderly rise in long-term treasury yields, I am quite confident and we as a house will quite confidently say that in that scenario, yes, the Fed will certainly consider bringing QE back in again in order to help bring yields down to more manageable levels.
So from genie to the crystal ball, what's the house view in 2025?
So for 2025...
or a bit longer.
No, let's... Yeah. I mean, we tend to focus on a 12-month view, so let's talk about 2025. We do think central banks will continue to cut rates more moderately than we thought the case was going to be, but nevertheless, they're going downwards. So you want to lock in attractive yields within fixed income. You do want to stay invested in equities. We do expect equities to end the year higher. Would I be rushing in to buy equities today? Probably not, because I think the market has priced in a lot of optimism ahead of Trump's inauguration, and therefore the risk of disappointment is quite elevated. So I wouldn't necessarily be rushing in, but certainly any kind of volatility would be a welcome opportunity to revisit the equity space and to look at ways of adding exposure. We continue to see AI as the investment opportunity of the decade. We are only a couple of years into the AI trade itself. And despite the fact that there's been an enormous run in AI companies, we do see further upside ahead. Certainly not as much as what we've seen thus far. You know, the big gains are of course behind us, but there is still further to go. We think power and resources are going to be an incredibly powerful theme over the course of this year, because the process of building data centers, the kind of power demand that it requires, the move to put a lot of the transmission, not transmission, I beg your pardon, the generation in renewable form is very robust. So the whole electrification process is going to be an extremely powerful theme, and it's going to be an important one for this year.
Anything on digital assets?
Digital assets, we don't really advise on, we don't focus on. It's an area of very high volatility. And while we are big fans of blockchain technology, we are simply not going to be giving any commentary on digital assets or cryptocurrency.
Fair enough.
Just to wrap up on what you were saying, what I was saying earlier on the outlook for the rest of the year, just a couple more quick points. We do see further weakness ahead for the dollar. It'll probably take a little bit of time for it to kick in. The dollar is very elevated now, but we do see material dollar weakness ahead. We continue to like gold. It's had a fantastic year last year. There's still some more upside to go, but gold and broader precious metals still remain very attractive for us. And lastly, real estate. In an environment where interest rates are coming down, real estate is a very obvious beneficiary. So that's also a very key idea for us.
Interesting. So generally a positive picture.
It is a positive picture. I appreciate that there is a lot of uncertainty now. And of course, when you're coming off the back of 2 consecutive years of more than 20% returns in equities, back to back, your immediate concern is, well, that can't possibly last. And sure, we might not get 20%, but I would argue that if you want to gauge the general trend, the general direction for where equities are going to go, you need to really focus on 2 key variables. The first one is central bank rates, and the second is earnings growth. And that's ultimately it. I mean, there's room for volatility on either side of it. But if you're in an environment where central banks are cutting rates and earnings growth remains robust, the general trend for equities will remain upwards.
Remain positive. Fahad, thank you.
Thank you very much. This was such a pleasure. I really enjoyed myself and appreciate the invitation.
Appreciate you coming this late in the evening. I'm sorry I'm keeping you away from your family.
Not at all. Not at all.
But no, it was a pleasure. I think it was at least for me, I learned a lot. I'm fairly sure the listeners will actually learn and gain from this. We don't often get CIOs right on the show. Mostly, it tends to be either bankers, mostly retail bankers and fintechs, but I think this is going to be a pleasant change. And we're coming soon to the end of our season, so I think it's also apt that we're talking about 2025 from a macro perspective in terms of what's going to happen. So thank you for coming in.
Thank you for having me.
All right. So ladies and gentlemen, that was Fahd Iqbal. He is the CIO with UBS Middle East. As I said, we're getting close to the end of the show. But do tune in to this episode. I think it's quite interesting. It's very, very different to our typical conversation. I think there was a lot more questions I got to ask here and didn't get as much participation because I think I was a little bit out of my own depth. But that was good, right? We sort of heard sensible advice, and especially I like the way we ended on terms of what the market outlook looks like, which was cautiously optimistic in my words. So with that, I'll say goodbye and thank you.